everyone. Welcome back to another episode of the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb, co-founder of HBG Capital. And today I've got on, and I don't want to butcher your name. I want to make sure I pronounce it correctly. Can you pronounce your name for the audience? Because I don't want to get it wrong.
Yeah, all good, man. It's Satch Bernhardt.
Satch Bernhardt. Satch Bernhardt, he's got a really interesting background. He's a pilot, but I want to formally introduce him. He's a real estate investor, former airline pilot for United Express. His flying career ended when his airline suddenly shut down. This was in the middle of the pandemic of 2020. This was a huge turning point in his mission with real estate. He's a co-GP on 350 multifamily units, and he's invested personally as a limited partner in 726 stores. There's a lot of limited partners listening today, so I'm excited to jump into your background there. Dude, welcome to the show. It's great to have you.
Thank you, Brandon. Thank you for having me, man.
So for those who don't know you, maybe explain a little bit about what you're up to today and give us a brief background.
Yeah, so through Bernhardt Capital today, we are helping mainly airline pilots invest in multifamily deals. Like you mentioned, we are co-GPs on 350 units, and we're looking for more assets that we can place more capital in. We are going to start considering bringing in other type of asset classes just because of the type of market that we're in. So maybe some mobile home parks. We do have a short-term rental portfolio that we're working on. That we're also we just like those. Those are not our main focus, but we like those type of assets just because of the cash flow that they bring in. So there's a lot of investors that are looking for the cash flow and not really the velocity of money, like not getting any cash flow and then getting a big payout 2 to 3 years down the road, right? So that's what we're doing. As you can imagine, and many people can imagine, the interest rates rising is making it harder for deals to pencil in. So there's not many deals that are going by, and which results in much less inventory for us to actually accept to join and partner certain investors in. So that's where things are. We're still trying to be as careful as we can, making sure that the deals fit the criteria that we're looking for, and obviously considering all the market, the situation, and everything that's going on, right? And dude, to elaborate on this story, I know you mentioned something about the airline industry, and so yeah, my primary focus is pilots. I had zero business background. I never even thought about being a business owner or an entrepreneur. I always wanted to be an airline pilot since I was a little kid. And when I started, as soon as I got out of high school, I just went straight into flight school and got all my licenses, became a flight instructor. By the time I was 21, I got hired at the airlines and I started flying. What ended up happening is when I was about 25 years old, so I had already been flying for about 4 years, and I started seeing that many pilots that were older than me with families, some of their regrets was like they didn't spend much time with their kids. They were gone on the road too much, and they just didn't have the flexibility or the freedom to spend more time with their family or attend holidays or stuff like that, right? So even though at the time I didn't have a family or kids, I knew that was something that was going to happen down the road. So I wanted to set myself up for success based on what I was seeing. So I said, if I can do something where I can supplement my income from the airlines, I can start dropping trips and not have to be gone on the road that much, right? So if any of your audience is an airline pilot, they will know the schedule can be pretty flexible. If you don't care about getting paid, you can drop your trips, right? Because
right.
You can post them. There's typically on the website for your airline, you can post your trips and other pilots will see it and they will pick it up, right? Because they just want more work. So that's pretty doable. So as long as you don't care about getting paid, you can do that. And so that's what started happening, right? So in 2018, that's when I moved into real estate. I stayed flying, but I moved into learning about real estate and started my wholesaling, flipping business in 2018. I started growing that business, and then in 2020, the pandemic happens, and my airline shuts down. And so our airline was an airline that we never thought anything can take us down. We were one of the biggest regionals that were around at the time. In fact, I think we were the biggest regional. So there was zero chance of us believing that anything was going to happen to us. And it did happen, right? So luckily, my real estate business was a thriving business, and I was making enough income that the loss of the income from the airlines didn't really affect me. And actually, I was already doing what I wanted, right? So I wasn't even flying that much. I was flying a trip or two a month. So the actual income that I lost, it wasn't really that significant for me. But what I did see was a lot of my co-workers, they were really struggling, because not only did they get not only did our airline shut down, but also no other airline is hiring because of the same reason. So they're literally out on the streets, right? There's no jobs anywhere for them. And that's when I realized, dude, like, I can help other pilots do the same thing that I was doing. If I can help them start placing capital in assets where they can start getting passive income, they will be able to start living the same lifestyle that I was having, where they can start dropping their trips. If the airline shuts down, hey, it sucks, but it is what it is, right? You're still going to be okay. And the
Still got the
interesting part is
mailbox
that,
money coming in.
yes, the mailbox money. The interesting part is that is not, some people may think, well, how many pandemics are we going to have, right? Well, maybe there is not another one in our lifetime, but the thing that does happen is 9/11 was also very devastating for the aviation industry. 2008 was very devastating for the aviation industry, right? So I don't know what the next event is going to be, but something is going to happen that is going to affect the airline industry, and many pilots will be affected as well.
Yeah, no, and things are moving into a more volatile situation with the current economy. You know, a lot of people are arguing, hey, we're already in a recession. It's going to get worse before it gets better. I want to come back to your single family, wholesaling and flipping days, because I share that background as well. And I love talking about the transition people make going from pivoting from one asset class to the next. But first, walk us through what was that like in 2020 when you got let go from your job unexpectedly, and what steps did you take to overcome that setback?
Yeah, so it was a little nerve-wracking, to say the least, right? Because even though I had already had the business for 2 years by that point, I still had the safety net of knowing that if my business just happens to fail, I can just go back and pick up more airline trips, right?
Yeah.
So the moment that goes away, it's like your safety net goes away, and I'm like, fuck. Now I have to. It's like burning the boats, right? I have to make this work. I have no choice. And I'll tell you something to add on to the uncertainty. Not only did I have to make the business work, but we were moving. My wife got a job out of state, so all of the business that I was doing was in my local market.
Mhm.
And now I was going to have to transition from being there physically to have to do everything virtual. So it was two limiting beliefs or limiting mindsets that I had to overcome sort of at the same time, right? And dude, I'm telling you, man, I didn't even think that I could do it virtually. But if you have no choice, you make it work. So, which is interesting, if you put yourself up to the task, I think you can accomplish many things. So, yeah, I mean, we moved to Iowa, middle of nowhere, but kept the business down in Florida. This is where I am from. So we kept the business in Florida. I met up with my business partner. We grew the company, and we still have it, actually.
What did the early days of pivoting into doing the single family market look like? How did you make that transition? And then at what point were you trying to grow and scale a team?
Yeah, so in 2020, it was still me and on and off with like a VA here and there.
Okay.
So it was it was So the transition was definitely, I wasn't quite sure the best way to go about it. I knew I wanted to grow the business. And I had already saved up money. So I was doing maybe about a deal or two a month up to that point. Right.
Mhm.
And I had been saving money because I knew I wanted to scale and grow the business. So right in the middle of 2020 is when I met my partner. We teamed up and we started both taking certain responsibilities in the business. Again, it was just still the two of us. There was not many people.
Yeah.
Towards the end of 2020 is when we started doing a lot of hiring. And we have enough cash saved up. So we saved up for 6 months worth of expenses for the business. So we knew even if we make no money for the next 6 months, at least we can pay everything.
Safe. Yeah.
And it was risky, but just in the sense that if we don't make any more money and we just run out of money, then obviously the business is done, right? But it was a risk that we were willing to take to grow. And so man, the transition to do it virtually, it was easier than I thought. You will be surprised at how many properties you can just put under contract with just talking to people over the phone. I never experienced that in the past. I had always gone to people's homes to like, hey, this is the contract, reading it to them, face to face. This is who I am. I'm a real person. To like, hey, I'm sending you the contract over the phone. Let me know if you have any questions. Let's sign it. Let's get it going. And they never even saw my face, right? And I never even saw their face either. So it was an interesting transition. But once I saw it was possible, then we sort of saw like there were no limits because now we could grow. And instead of just staying in one county, we were starting targeting the entire state of Florida. And now we are in Florida, Missouri, and North Carolina.
Okay. Yeah. It's interesting. A lot of the times the only way to crush your limiting belief is to be thrust in that environment. When we had a wholesaling house flipping business, it was a very present moment. And I saw the guy doing it virtually. And I was like, oh my God, like, how could they possibly do that? How are they doing it over the phone? They can't see the property. There's a lot that goes into it. I know you've got experience. You built a pretty big team. I think 31 members or something like that. Walk us through, what did scaling that business look like? What steps did you take? And did you have a specific order of like people that you knew you would hire? And like, what framework did you use to build and scale that business?
Yeah. So the last positions we wanted to delegate or to hire someone for were the acquisitions and dispositions. I had always stayed in acquisitions, and my partner had always stayed in dispositions. In the first, we started hiring people for our marketing department, which was mainly cold callers. That's our main strategy. So we started with 1, and then we went from 1 to 5, and then from there 5 to 10, and from 10 to 18. And it was just our best way to describe that was we knew we wanted to scale the marketing, and we said, okay, the first thing we want to grow is we want to grow our lead flow. Once we can grow our lead flow and maintain consistent deals across the board that we're generating, which were generated by me, then we're going to outsource me and hire someone else to take my spot. And then the last position we're going to give up is the disposition, because that's the person that is controlling essentially how much we're selling our contracts, our deals for, right? So
why did you make why choose that position specifically last?
And I don't know if this is the right I don't know if this is the right answer for other business, right? But we just felt that person was the last person controlling the deal. As a salesperson, I can go in, as an acquisitions, I can go in and put properties under contract at whatever prices, but then that person is the one that decides what offer we're taking for the property. It needs to be more strategic of a position of deciding who is the best buyer for this. Are they going to waste our time, or can they really perform? And is that the most that we can get out of this property? That person sort of holds a little bit more knowledge on the market, comps, knowing what other buyers are paying for in the area. Is that the best exit for that specific property? So they hold more keys to the more pieces to the puzzle, putting a deal together than the acquisitions, right? Acquisitions is more sales heavy, put the properties as low as you can on the contract and
Yeah.
pass it on.
Very interested to hear that. The reason why I asked, I know a lot of formats that business owners follow as they're scaling is they figure out what they're best at and then hire that last. I know for me, it was the acquisitions role with my background in medical sales. I had a little bit of an advantage over there moving in the real estate industry. So I've seen it done a million different ways. One question I love to ask guys like you with your background is there's usually a light bulb moment. And everyone I've spoken with, and there was for me as well, when you pivot out of doing just wholesaling, flipping, entry level, single family to doing, multifamily or new construction or whatever that new pivot is, walk us through that light bulb moment. And then maybe the story of how you made that transition.
Dude, the light bulb moment was when I realized I did not have to do everything on my own. From coming from the single family space, it's all on you. You're managing the flip, and of course there's people, and I know you yourself, you're very systematic on doing flips, doing rehabs, and undertaking the project. But the way we were doing flips was not like that. Was not by any means any systematic approach. It was very like I was doing everything from managing all the contractors, helping them sometimes pick some materials. So it was very work intensive. It was requiring a lot of time. So needless to say, we stopped doing flips and just went 100% focused on just wholesaling, just because it was the most streamlined process that we can execute over and over and over and be repetitive and not take too much of our time. But then I realized I always wanted to go to multifamily just because it just seemed like that was a natural progression. That's like the big thing. That was like the big challenge to pursue. And you always hear like the big guys are the ones that own the multifamily deals, right? I never knew. I always thought that every multifamily building that I saw when I was driving around, that it was owned by like a single person that just simply that person just simply happened to accumulate a lot of money and was able to put a down payment on a $30 million building, So, and that's what held me back. That limiting beliefs right there, that piece of knowledge that I thought was true, was what held me back since 2018, since I started real estate, thinking that I had to accumulate a lot of money to buy an apartment building, and I did not know syndication was even a thing. So the light bulb moment was that when I realized that all these buildings are owned by a group of investors. It's not just one person. And right. I can leverage the expertise of another team that is very good at executing and operating the property, that maybe needs a little bit of capital to keep growing and keep acquiring more properties. And I said, all right, this is my way in. I'm gonna start learning more about syndications and see how I can start by adding value to other operators.
So you pivoted by partnering with people who already had a good grasp of the industry, which I think is the best way to do anything. If I decide that I'm going to go into private equity tomorrow, the first thing I would do is I would go figure out who's doing private equity really well and go figure out how to add value in some way, shape, or form. Maybe it's bringing, going and finding startup businesses and bringing them. Who knows? That's a great way to transition into it. Now, did you talk to us about scaling that? Because I know you're co-GP in quite a few deals. You're also a limited partner in quite a few deals. How did that transition from limited partner to GP? Like, how did that happen? Walk us through that.
Yeah. So I first wanted to do the LP just because I wanted to see how it works. I was getting educated, listening to podcasts like yours, and reading articles, reading ebooks online. So then I had enough theory and understanding of how syndication worked. I just needed to see it in reality. So I started doing my due diligence on operators, and then I went and invested in a couple of deals. And once I saw how everything worked and I started seeing my returns and how they communicated, then I felt comfortable to start same operators to say, hey, I'm an LP on that deal. I feel like I can bring some capital for your next deal. Can we do something here? And that's how I started leveraging those relationships that I already had to start partnering with those same people. And scaling that business is a fairly new business. So I've been working on this for less than a year, and I made some mistakes at first about trying to go wider on my audience until we're part of the same mastermind, and then I was told to start narrowing down my audience that I want to target, right? So that's once I started narrowing down my audience, things are started getting better, and now I have been able to starting to grow that business, place more capital in different deals. So the way to scale is just to start getting more social media presence. You don't realize how much branding and social media presence is as important as when you start doing a business like this.
Right. Yeah, branding's huge. Maybe we touch base on that here in a second. Now, you made the pivot, started out as a limited partner. You did something that is really smart, which you didn't just jump in with other people's money. You jumped in with your own money first. You tested the waters, you learned, you wanted to see what it was like. And then after you felt comfortable and you gained an understanding, then you started inviting your close social circles, probably people you had a pre-existing relationship in, and inviting them into that deal. That's I think the best way to go about doing that for those listening who are interested in jumping in. Talk to us about multifamily now. So, you've got almost close to 1,100 units. Tell us a little bit about your deal selection criteria. What markets are you in, and what are the motivating factors driving that decision?
Yeah, so markets is Arizona, Texas, and Florida, even though I don't have any deals in Florida, but it's a market that I will invest in when the right deal comes along.
Yeah.
All of the other deals are in Texas and Arizona.
Why those states?
So my belief is I don't like anywhere that snows. So I won't invest in
Okay.
I won't invest in any deals. If it snows, I don't want anything to do with it. But the reality is that it's pretty easy to tell that, okay, this southern states, there's population growth, which is one of my criteria, right? I want to make sure that there's people moving in. And as a consequence of that, there's job growth as well. And the third piece of the puzzle there is taxes. I want to these three states that I just mentioned, they have either no or very low state income tax, and in my opinion is something that, as the way things are going in this country, this type of states will keep attracting more and more people. So these three things alone will at least ensure that real estate that continues to grow, right? Obviously in select submarkets within these markets that I'm mentioning. The next thing after that is, if a deal comes in one of those areas, then it just becomes very deal dependent. What's the location of that deal? How are they underwriting it? Was it next to, like, is it in the hood or is there a nicer area?
Now, tell us a little bit more. Let's get granular on the area. What are some of the red flags that you see when people bring you deals, and relative to the area itself? And then maybe what are some of the green flags that you're looking for?
Yeah, it's mainly the area will be more like, is it located? Are there a lot of apartment complexes around, and like, are those like much newer apartments, and are they trying to use, like, is this one are the newer apartments that were like built in 2020, and this one that we're looking at is a 1960 build, and they're trying to compare the price, the rent comps of those 2020 to this one is 1960, so it will be just a little bit like that. I'm not too picky on, like, I will do a class C. I don't care if it's a class C. I don't care if the neighborhood is a little bit bad, but as long as we're being realistic with the numbers
Mhm.
on, I shouldn't say that the neighborhood is bad, but you know, as long as we're being realistic
Yeah,
with the numbers that we're
makes
looking
sense.
at, and it's like, okay, well, those neighbor, this is not a premium area, but at least the numbers that we have are realistic. And yes, we can attain those numbers. So that I'm good to go.
Okay, so you start neighborhood, look at other apartment complexes. You're looking just how bad is it, right? Is crime going to take over and deter people from wanting to occupy it? What does the competition look like, right? If you're trying to buy a unit that's probably equivalent in rent to like a brand new unit, probably not a great investment. Competition is going to make them go to the newer unit rather than the old unit. When it comes to selecting sponsors, I think the biggest mistake I've seen limited partners make is they trust too easy, and they're very, very trusting with their money, and they don't do all their due diligence on the sponsor. And I said there's two big parts of any real estate deal. It's either the sponsor or the deal. Both of them have to be really good. So maybe walk us through some of your due diligence, maybe when you were a limited partner, when you were maybe first starting out or kind of got the hang of things. And then what have you changed today in your due diligence when selecting the right sponsor partners?
Yeah, so something I did not do at the beginning was ask for the underwriting, and I just trusted what the deck, the offering said. And so I'll never do that. If you're a passive investor, unless you know this person from like a long standing relationship that you have had with them, then obviously if you're looking at the deck and you trust them, then go for it. But otherwise, that was the first mistake, and nothing happened, nothing wrong happened with the deal, you know, but I just saw the deck and I was like, man, this looks awesome, right? 2x
Yeah.
return. But then you start realizing that every deal has a 2x return. Every deal projects 15% plus IRR. So everybody will throw numbers out there to make it look super nice, right? So look at the underwriting. You don't have to go be an expert underwriter. I'm not an expert underwriter either at this point, but I can go and look at the underwriting and kind of tell some basics, you know, like for example, I go and look at the expense ratio to income. And if I saw an underwriting one time where the operators were projecting to reduce their expenses down to like 30% of the income, you know, so I'm like, okay, that's not realistic, right? I would say if you see realistically, you will have to see something between 40 to 50% being more likely the case, 45% if they're pretty good at it. 40% I'm started getting a little bit skeptical, right? The other thing is the exit cap rate versus the going in cap rate, right? You want to see the exit cap rate being higher than the entry going in cap rate. I have yet to see anybody show me an underwriting that the entry cap rate is actually lower. The exit cap rate is lower than the going in cap rate, but I've heard that that's out there. So always check the underwriting for that, right? It is not too hard to look for that. The other thing is the rent comps. Usually you will see on the underwriting rent comps. So don't trust just the numbers that are on the underwriting sheet. Actually usually you will see which property that is that have those rent comps. So go and look at that property. You can find all that information online, right? You don't need CoStar for that. So you just go and look for that apartment complex, look what those rents are going for, and just see if the numbers that they're putting there on the underwriting are realistic. Something that I saw is another thing was that I did not know at the beginning was how fast can they turn units around. Some people will project that they will complete a 200 apartment complex in 1 year. It's like, dude, you can't do that, you know. That's way too many units.
Super renovator.
Yeah, and even if you can do that, you know, you're gonna have a lot of turnover that your income is just gonna go down to the floor, right? You can't just kick everybody out and like turn all the units around, and it has to be a gradual. So this last operating team that we're working with, like the sweet spot is 6 properties, 6 units every 3 weeks. So that's like every 3 to 4 weeks, so that's like it's just a little bit slower. It's not too fast. Not too many people leave at the same time. We keep that income coming in, and it's stable.
Making sure that it's cash flow. And that's great due diligence advice for those listening who are interested in doing your own vetting. Rewind that and listen to everything he just said. I want to pivot over to a hot topic right now, interest rates. Everybody is talking about interest rates and the effects it's having. So with everything going on in the news, walk us through, what did the environment look like this time last year, and what are you seeing today after these crazy hikes we've had?
Yeah. So last year, everyone in either single family and multifamily are being super aggressive, buying properties, a lot more deals. There were a lot more deals will pencil in, and the other thing I was going to mention is that if you ever see anybody, sorry, I don't mean to backtrack, but just thought of this, the rent increase every single year. Some you that's pretty easy to tell as well, right? How much rent they're projecting every year to go up, and if it's more than 3 to 5%, then it's probably, you should start getting skeptical about the underwriting, right? Because
Yeah.
obviously we've seen in this past few months, we've seen rent growth up to 15%, even 21% in some areas, some very hot markets. But if you see anybody underwriting using those numbers, they'd run away. But let me bring it back to the interest rate. So yeah, a lot of deals were penciling in. Now it is very hard to have deals pencil in. As the interest rates keep rising, deals just don't make sense. A lot of investors are not wanting to place their money in deals. And they're asking me, I don't have a crystal ball to know what's going to happen, right? I have no idea. All I really know is a lot of deals are not making sense anymore. And it's taken a little bit for sellers to catch on to know that the market is transitioning. So even though deals are not making sense, sellers still have the idea that their home or their properties value a lot of money. And so that's kind of making everything to be sort of stagnant, right? Because, okay, well, so like we're not buying your property, deal doesn't make sense. And sellers are thinking, oh, well, my property's worth X, and it's not.
Yeah,
so
we're seeing the same thing right now. There's a sticker shock where there's a psychological readjustment that is currently happening. If you're in the market to buy a single family $500,000 home, you're now shopping for a $385,000 home, right? That's some pretty big sticker shock. But it's interesting because we still have a huge housing shortage. We still have a huge shortage on units nationwide, and that drives the decision we made that something is going to have to happen. There's these really big forces that are pushing on each other. One of them being interest rates. How do you see interest rates affecting future rents?
I would like to say that rents will keep going up, because even though there's a housing shortage, I have already starting to see many houses stay on the market a lot longer. Every day we're having communications with all of our buyers, who are like the guys at the forefront who have properties on the market. We already had 2 buyers with 2 flippers, rehabbers within our network that went out of business. They had properties on the market that sold, and they had to give drastic price reductions just to get rid of those properties. And that cost them to go out of business. So I say that to say that properties are starting to not move as much on the market. And that's going to cause a lot of people to start renting. So they will start moving into apartment complexes and rent, to wait until either interest rates come back to normal and they can afford a house on the market.
Yeah, it's interesting when you get this sharp rise in rates, you just pushed a whole segment of buyers into rentals. Basically, I'm very bullish on rents. I think rents are going to go through the roof. They have been going through the roof for that very reason. We're also seeing a lot smaller homes start to be built to try to cater to the affordability in the market. before we get into how people can get in touch with you, walk us through what are you working on right now? Anything fun and exciting?
I don't have any deals that I'm currently working on right now. I keep getting asked by many operators to help them bring equity into deals, but I'm being very extremely careful with every deal. So I am probably gonna hold back and then wait until another month or two to find a better opportunity. And I'm in constant communication with all my investors to see what they're thinking, how they're feeling, what kind of asset class they will prefer to invest in. That's where I came in at the beginning of the show. I mentioned the mobile home parks. I think a lot of them know the mobile home park is a very safe asset class, in the sense that a lot of people that just don't have the type of income, even especially after retirement, to move into an expensive place. Mobile home parks is like the place where they end up, right? And I'm not pushing mobile home parks in the show. I love multifamily. That's like my number one focus, but I'm just trying to cater to what my investors are looking for. And so that's my current focus right now.
Good stuff, man. Satch, this has been fun. If people want to learn more about you and upcoming opportunities, where do they go?
Yeah, for sure. If you have any pilots in your audience, or anyone that has a similar type of job where they can do something like pilots can, go grab my ebook. I explain everything on how to start getting your freedom back, so that you can have more time with your family and your kids and never miss another baseball practice from one of your kids, So go to my website, is bernhardtcapital.net/ebook.
All right, guys, y'all heard it. Bernhardt Capital. What was that one more time?
Yeah, bernhardtcapital.net/ebook.
All right, guys, go grab the ebook. I appreciate it. Good seeing you, my friend.
All right. Thank you, Brandon.
See ya.